Built Better, the podcast for home improvement contractors by Modernize Home Services.
Welcome to the Built Better podcast. On this episode, we're covering the current state of the economy and how it's affecting the home improvement industry. We brought in Nikolas Scoolis, an economist and the manager of housing economics at Zonda Home, the #1 provider of housing economic data in the U.S., to talk about what contractors can expect and how to prepare. Nick, thanks so much for being with us today. Welcome to the Built Better podcast. Really excited to talk to you.
Thanks for having me. I'm excited to be here.
Yeah, absolutely. Yeah, so there's a lot going on with the economy and inflation and customer sentiment, and a lot of what we do here on the podcast is talk through just tactics and a lot of the trends that contractors are seeing and tactics they're using to make sure they increase their business and business efficiency. A big topic of conversation is just a lot of the stress that homeowners are going through right now with the economy. So I wanted to talk a little bit just to begin with, kind of what do you see happening in the economy as it relates to inflation and, particularly with the home improvement marketplace right now?
Yeah. So obviously inflation is a very hot topic, and it has been for almost over a year, or a little over a year now. A lot of people thought it was going to be transitory, but obviously that turned out to be not so true. Where we're at is not necessarily good, but I think we're in a position where we're going to start seeing some disinflation in the economy. Disinflation meaning the rate of change is declining, where deflation would be the rate of change is actually negative. And a lot of that is just moving parts. As we know, the Fed is raising rates in response to everything. And the intention of raising rates is to essentially taper, slow demand, slow the rate of borrowing, which should help bring back those inflation levels down towards a more appropriate level. But it could take some time.
Yeah, and just in terms of timing here, so we're recording this right now, July 7th of 2022. And everybody has kind of different estimates based on where all the different factors are, conflating on each other. Definitely seeing a little bit different inflation levels for each area of the economy, so food different than commodities. Kind of, if you were to give a time frame when you're going to start to see things stabilizing, because I know that's the big question that we have. What do you see from a time frame perspective? Are we talking months? Are we talking years?
I think in terms of stabilizing where we're at now, I think we're either at or just past the worst of it, and I expect that to keep coming down. Obviously, the Fed likes to target about 2% inflation, and I don't think we're going to be at 2% inflation for a little while now. But we should be able to get it down to a much more manageable place, maybe at like 3 or 4% by the end of the year. Obviously, a lot of that depends on how the economy continues to respond to rates rising. And so far, it seems like, obviously, we took a huge 75 basis points jump in the last meeting, and I expect them to keep raising rates probably through the end of the year. So it's going to be a pretty substantial increase. And that should keep moving us in the right direction. Something that's really interesting with our current inflation issues, which may be unique compared to past instances, is that this was both a part of supply chain disruptions, which happened early on in COVID with factories shutting down. Obviously, on the lumber side, mills shut down, but also demand completely stopped. And that was part of the supply driver, is that they responded to it. But then it kickstarted into overdrive within just basically a 2-month period. And our supply chains have really never had a chance to recover. And then obviously further, we had stimulus poured on top of that. And it can be kind of attributed to our quote unquote K-shaped recovery, which means as the economy came down, part of the economy basically went on like nothing was happening. Like the recession wasn't happening because a lot of us got to work from home, keep our jobs, and instead of spending on the things we normally did, which would be like a vacation, we were just having all this extra money in our pocket. And after saving for a couple months, we're like, all right, we got all this extra cash on hand. Let's buy a house. Let's buy any hobby activity you could ever think of. Like, people were just spending because their expenses were basically staying the same, but they weren't outlaying these big service expenditures. And then obviously the other half of the economy was kind of lagging or left behind until recently, where jobs were kind of starting to pick back up. But then as that happened, we're kind of transitioning into a new recession.
I'm glad you brought up the supply chain. I'm curious though, like when we think of like rising inflation, like obviously supply chain issues were a big deal. We heard that across the board with contractors, roofing tiles, I mean, PVC piping, I mean, pick a product, it was challenging. I think wood was one of the ones that most people like nearly had a heart attack on. But when we think of like, when you mention like we're at the worst of it, or maybe there's some deflation coming in, is that, where would we expect to see that first? Like, I mean, I was at the grocery store the other day. I asked the clerk, I was like, look, food's getting costly. Like, how much is this gone up? And she's like, 30%. I mean, keep in mind, it's sort of a Whole Foods type store, but she's like, it's crazy. It's 30% higher right now. The same token, you know, I got this newsletter that came in. This was probably about a month and a half ago. And it was like, lumber prices are falling left and right. And so when we sort of think of like overall inflation is probably pretty high, but when you start to think it might be coming down, is there one sector that gets hit before the rest of them? And it's sort of like the trigger sector and then it like cascades into the rest, or does it just sort of randomly happen? What's that look like?
Yeah, so if we're talking housing, obviously, as you said, lumber seems to be getting the relief first. And that could be partially due to it was then most impacted first. So it's just kind of working its way through the cycle. But if we're talking about outside of housing, what's happening in gas prices is kind of wild because energy in general is so volatile. The crude oil price has gone below $100 a barrel. Well, that was yesterday. This morning, it's now gone back up. But we should begin to see some relief there based on the prices we're seeing on the supply chain on the backside. So hopefully, and we see those prices come down because in California especially, they're super ridiculous right now. Some places pushing almost $7 a gallon. But what's driving inflation most, if you look at like the CPI, what's being calculated, the energy sector is actually up like 30%, whereas the headline CPI is about 8%, and then core CPI is even lower, about 6%. So energy expenditure is going down, and especially in summer when people are doing more, that is a really big driver of how people feel the inflation is what they're paying at the pump, because still got to go places.
Yeah, Nick, I mean, you know, you bring up a point about consumer sentiment, and then like we every year we take a consumer sentiment survey. So the last couple months we took a survey just to talk a bit about the stress that they're under and how likelihood that stress is going to turn into limiting projects or moving forward with projects. And when we took that survey, it was pretty stark. 40% of homeowners say there's no way I can afford to accomplish any home improvement plans right now in the economic and supply chain environment. 69% of homeowners say high cost of supplies is really the biggest barrier to taking on home improvement projects. You know, we look at consumer sentiment, but then we look at other data, talk about consumer spending, and that sentiment was in place when consumer spending was still high. So how much of this is actually, you know, kind of driven by more about what people are hearing and fearing versus what's like cash on hand and what's actually possible in the environment or in the economy, if that makes sense?
Yeah, for sure. And there's no doubt what people are reading, and especially now in today's age of information, is just like in your face all the time. Consumers are going to react more negatively to that. And when you're talking about big outlays, like a remodel or whatever it may be, like you don't want to be putting all this money out if you think you might be losing your job. So I think that definitely matters. And I think how you message those investments matter. But I think once people step back from it and kind of realize that, oh, we're doing okay, there's money to be made on an investment, I think people begin to process it. But I think consumers are very reactionary in terms of what they see. They don't want to be rushing in. They don't want to, especially with the Great Recession in the back of mind, like all those people were rushing into buying houses in 2007, 2008, where the warning signs were flashing. And obviously today is not that. But I think the psychological impact is important because you got to want to do it, even if it pencils.
Do you think that changes the type of projects that people will kind of tackle first, or where in the scheme of things,
Yeah,
right? The need base versus the want.
yeah, for sure. At Zonda, we have Todd Tamilak, who is the head of our building projects manufacturer segment of our company, and he's done a lot of analysis on this. And what he basically calls the next 5 years is basically the golden age of remodeling, but with a recession in between. And what the recession may do is those minor maintenance projects, they'll get brushed aside. People will try to do it themselves. They won't be doing those type of things. But the value add, those middling projects where you're maybe like doing a full improvement of a type of maybe like a kitchen, a bathroom, something like that, those should still be strong. But then again, on the other end, the very large, like moving walls around, those will probably be hit a little bit. But overall, as long as there are certain conditions in the economy, obviously, if we turn into a 2007 type situation where jobs are cascading from the economy, or we turn into a situation where inflation remains high and home prices are coming down because there's lack of transactions, that's a different story. But based on where it looks like we're going, it seems like it's still going to be a strong remodeling space due to a variety of reasons, which we can get into in a little bit.
So I'm curious on that, like, just to follow the logic. So you're saying like smaller, more potentially DIY type projects, maybe pushed aside or at least handled outside of like professional contractors, and ones that might add more value to the home. So is that just another way of saying, if we can pour more money into an asset, like we're willing to spend more money as long as that money is potentially protected, or can be recouped at a further rate? Is that the logic behind it?
Yeah, that's the logic. It's what he calls the sweet spot is about between $7,000 and $35,000 investments in your house. In that range, he thinks that will be the best rate of return. And also historically, like we've looked back at historical recessions, and in terms of the high inflation recession, that's about the 70s. And then when you're looking at basically home improvement data and home improvement consumer spending, as long as incomes were still growing, or not incomes, but prices were still growing relative to inflation, the remodeling spending was going up. So there's strong historical precedent as well with that kind of logic that people will continue to put money into it as long as it doesn't tip past a certain point.
In terms of historical precedents, I mean, how far are we outside of historical precedent though from previous times? I mean, you got a combination of things that just didn't exist before, right? So you've got people can now go from a, big city and then go move out to the country. They can get satellite internet now, from companies like SpaceX, right? So you got broadband internet, so you can be on Zoom and work wherever that you want to go, and these are the people that are going from like, California with their $1 million house. They can go buy, a $300,000, $400,000 house in, rural South or North Carolina, right? And so you inject money into markets that typically were depressed over the past decade, right? So that seems like a very atypical place that we're in versus any historical precedent.
Yeah, and I think using recessions as historical precedent in order to 100% guide your future decisions isn't most prudent, because every situation is so unique and there's levers being pulled all over the place. But it's just kind of like, it's nice to be able to look back and see positives in a time that share some similarity. But what you mentioned is one of my longer term recession excluded fears of how the economy, not necessarily a fear, but a worry, I guess, of how the economy responds to the new work from home environment. Are employers going to be able to bring people home? And if so, does that return people from markets where they may have moved for a cheaper housing that don't have that internal job hub? Like, I think places like Indianapolis, Raleigh, Charlotte will all be solid. They have the jobs there to provide the high income jobs that homeowners need. But if there's places further down like Boise, and employers use a recession to decide to try to get leverage back on employees to bring them back in the office, does that flood the market with existing homes? We don't have any idea because we've never been experienced this before. But things like that just give me a worry. Also, when you talk about those high income jobs and people moving out, largely they're going to be okay, but there's labor issues that they'll probably face going forward if a certain type of person is leaving the economy because let's say you're 1%, 5% of the local area, you're going to be fine. You don't need to relocate for a house. But there's certain households that may need to relocate, and those certain households work certain jobs in certain areas. And then is Southern California going to be under labor supplied in those certain areas for a very long time with not a big sign of relief? We'll see.
Yeah, that is the one kind of thing I think everybody fears, right? It's like, how does those different moving parts in the economy play off of each other? And there's just no historical record for it, right? Maybe instead of some of the doom and gloom, I'd like to ask you, like, what's the positive of all this? Like, how can we turn this into more of a gem? With all the technology, all the automation that's happening, all the ability for us to kind of navigate this with the new era that we're in. Like, what are you excited about in this type of condition?
Well, in terms of looking into a recession, like, we're so much better off than we were 15 years ago. In terms of historical equity, homeowners have built record on record levels of equity to prevent themselves from defaulting. And that's kind of what cascaded the Great Recession, is people were defaulting on these homes that flooded the market and in turn brought everything down. And additionally, borrowing data, despite affordability crunches, is really, really strong still. We get data from Fannie Mae and we're kind of expecting a tick down, but we haven't seen it yet. And so that makes me very happy because I don't want to see the defaults coming. In addition, as you said, the access to information I think is really important, because if people know now that they're not going to be able to make their payments, they can take their equity and run. Like, there's such a mismatch in supply and demand. Looking back maybe 6 months ago, we were hearing from builders that there's basically 10 buyers to each home. And the demographic push in demand is there. It's real. Like, people in their late 20s, early 30s are moving into that family having home buying stage and are just waiting for an opportunity to buy a house so they can nest, have kids, etc. The affordability is something to work around, but the savings and the desire to buy a home is there. How you do that with rates at 5 and 6% plus the 20% appreciation is another question. But the demographics are really, really strong, especially for the home buying industry, remodeling industry, especially when you're talking about people who may be living in a house that is pretty old. Looking at remodeling, another reason we kind of call it the gold major remodeling coming up is in the next 5 years, we expect the number of homes in between 20 and 39 years old, which are usually prime targets for kitchen remodels, bathroom remodels, siding redone, is going to increase about 10% in that period. So there's a lot of demand that is going to be there going forward. We just kind of got to make it through this rough patch first. And while I think we're going to enter a recession more likely than not, as long as we don't tip past a certain level, which I don't expect at the moment, it should be okay coming out of it, rather than the Great Recession, which was such a slog.
Am I right, Nick? I swear I read it, and I apologize for not being able to cite it, but home prices over the last 12 months, and I think this is on a national level, but maybe you can correct me a little bit, they've gone up about 20% or something within that range. I'm sure it's a little different by market. Is that roughly accurate, somewhere in that range?
Yeah, like you said, it depends by market. Case Shiller, which basically indicizes home prices, are as about 20% across the entire country. Some markets, especially Florida, have still remained red hot, even with the rate price appreciation. What's pretty crazy though is, like, the numbers make me I just shake my head, is some markets in Florida, when you're talking about the price appreciation paired with now rates have dropped tremendously, basically 40 basis points in a week. The most recent average is about 5.3, but they were looking like they were going to be 6 about a week ago. And if you were looking at just from year end, which is about 6 months, as you were saying, from year end to now, that monthly payment change is about 50% in 6 months from where it was, which is wild. but people are still buying in Florida. I think we're starting to see some signs of slowing there, but all the data that we've seen backward looking was still strong, which is crazy to me.
So I'm curious, and hopefully, Dom, I'm not jumping the gun too much on this, but I've been thinking of this question for like a week to ask you. And so like when I think of like those people that are going to be spending this money on a remodel, whatever that is, the new roof, new solar, new kitchen, whatever, I can't help but think of like, where are they getting this money from? Like, is it, when COVID hit, it felt like asset prices were not taking they weren't getting like chopped off at the knees. Like it was sure there's some issues there, but we saw a really strong demand. Now I'm like, wow, the stock market's going down, a lot of asset prices. I mean, obviously real estate's gone up. Do you think like the way people will pay for these projects is very much like they did when it was with COVID, through personal savings or some financing or that? Or do you see this as like they're pulling equity from their house because their house has gone up 20 maybe plus percent, and they're going to pull a little bit of the equity out and remodel? Like, where do you think that spending is coming from for those people that are going to push forward with the project?
I think you kind of have to separate the recent buyers from historical homeowners, because like looking at what happened in 2021, basically there were about 4.5 million people who moved, and movers do spend more on a remodel typically because they're buying a house and they want to make it theirs. But the non-movers still spend about $3,000 on a renovation. And there's so many people that have been in a house for so long that haven't moved, that aren't necessarily dealing with the same affordability crunch, because if they refied throughout the process and got about a 2.5% rate, their monthly payment might be depressed compared to where they were previously, and that's extra cash on hand that they could be saving and spending. So I think when you look at it that way, there's obviously still a lot of buyers out there who can and have cash to remodel. I think if you're thinking about specifically the people who have bought in the last 12 months, that's a good question, because the prices, and especially even more recently with rates being higher. Like I was home shopping late 2021, and I got quoted about 2.6, which is a crazy low rate. So there were ways to kind of offset prices prior to the last few months that we've seen in a big way. And that's partially what made prices to go up so much, is that they were taking the savings from the rates being low and just kind of saying, okay, we can charge more on the top. But I think a lot of the people who have owned, and especially those who bought prior to the Great Recession, are in a position where their monthly payment is much lower than their incomes have appreciated. And I think those would be the people, maybe if they bought new homes in the early 2000s, their homes are about 20 years old, which is typically about when you're going to see that kitchen remodel, bathroom remodel, that type of thing.
Do you feel like, and this might be out of scope for the conversation, but do you feel like banks, lenders are kind of pivoting to the fact that, folks have so much equity in their house and there's so much upside there and they can leverage that equity? Are there any financial products that might be changing in a new type of situation that we're finding ourselves in the economy? Or how does that factor into all this?
Yeah, definitely. I think especially with baby boomers retiring and such, there's targeted investments for them specifically, like to say, use your money before it's too late. Like, take your equity, use it. Also, we're starting to see a rise in adjustable rate mortgages, which not to a level last cycle, but definitely an uptick. And that obviously means that the rates are adjustable now and hopes the rates will go lower in the future, which isn't necessarily a bad decision, but it's something to monitor going forward.
Yeah. Do you think, just in terms of being able to just refinance, so let's say you get into a new house, you maybe pick an ARM product, and then you're banking on the Fed reducing rates and seeing that follow. And then, in Texas, where I am, you can only refi every year. But in other places, you can refi, closing costs are closing costs, right? But you can refi it any many times you want without limit. Does that factor into, kind of what you're seeing as well?
I definitely think it's possible, especially if you're moving into that stage where you really want to remodel, because as you mentioned, and the record equity across the country is basically like, I have a chart somewhere in my notes but it's vastly supreme. Even when adjusted for inflation, it's vastly past where we were in 2007, which was even a housing boom then. So there's a lot of untapped equity, and obviously a lot of the untapped equity is what drove the relocation buyers that you mentioned earlier, because if you generated about 500,000 equity in California, that covers your entire house in other markets.
Yeah, that's exactly right. In terms of just equity aside, though, I haven't looked at the recent data, and I don't know if I have access to that, but I think something like in March or April, I mean, we had record cash on hand for most consumers that was driving a lot of this spending. Do you have any recent data that suggests that is slowing down or that's impacting anything?
I don't remember off the top of my head, but I think the recent consumer spending data did decline on a month-over-month basis, not an alarming amount. I'd have to fact check myself on that. But I think part of that is also no one's really sure where to put their money at the moment, because obviously the stock market's being hit. If you were into alternative investments like crypto, obviously that's not good. So I think people have cash on hand, which may have contributed to inflation, honestly, is that people were having, okay, if my money is just going to sit in the bank, I might as well spend it into something that might provide value to me in the future.
Yeah, that makes a lot of sense. So we chatted through kind of similarities and, differences from the 2008 recession. We chatted through kind of where projects might be going, customer sentiment, all that stuff. In terms of interest rates, the things that the government, that the Fed can do, maybe, I mean, do you see other things happening? If you were to say, hey, 6 months from now, it's a high likelihood that this lever is going to get pulled to try to improve things. Like, what are those types of things that you can foresee?
I think they're just going to commit to the raising rates because they've already committed to unwinding the balance sheet, of course. I think I'm of personal opinion, I don't think there's any way to say 100% what was the right decision. I think they waited too long. And I think if they had waited, or if they had acted earlier in squashing inflation, we'd be more likely to hit a soft landing where we just kind of growth tapers off, but we're still positive and growing. I think most likely they waited too long. And I think that's why we saw 75 basis points, and we'll see rate increases going forward. At some point, that balance is going to tip in their favor in terms of getting it squashed out. But I think that's what they're committed to. They're just going to raise and raise aggressively.
Is that an argument to be made, though, Nick? Like buy now, lock in a rate, like before it gets too high? That
for sure?
That...
Yeah, 100%. Yeah, that was very common earlier in the year, and funny we're talking today because literally rates, the average national rate was about 5.7 last week. It's 5.3 this week. That is a shocking drop in a 1 week period. And for that, I think you could see a lot of driven marketing where it's rates are 40 basis points lower than they were a week ago. This is your time. You're saving money. Try to lock it in. And I know builders are not fully leaning into price decreases yet. We're starting to see slightly more use of incentives and definitely less price increases. But I think before any of that, we're going to see a lot of builders marketing more, because basically they were in the best business of all time, where they didn't have to, people just came to them and they had too many buyers. So they didn't have to try to sell anything. So now we'll probably start seeing them try to sell again. And that should help them a little bit, at least going forward.
Yeah, especially in Northern California. So I think you're in San Diego. I'm in Northern California. And so we've, over the last handful of years, had some, you guys get fires down there in SoCal as well, but it's the builders out here in Northern California, it's like they're choosing of how many clients they want to take on. There's no shortage of people looking for work. And so as that demand picks up, their prices pick up as well. There was a couple questions that came in, Dom. I don't know if you caught those on your side that we had from our contractors. I can read them if you don't have them.
Yeah, go ahead, Chris.
Okay. I think we covered a little bit of this, Nick, but just to kind of read it as it came in, there was a question on how will rising inflation affect the homeowner's decision to buy a new roof? Will they have to wait until inflation goes down?
So yeah, we talked about it a little bit. I think when you're looking at historical precedent as well, we've acknowledged that isn't everything. As long as inflation is below what prices are appreciating, which they currently are, just alternatively said, real home prices are still going up. Traditionally, that means there will be investment. If we pass that lever where inflation is higher than home prices appreciating, then we might start getting pause. But I think, as we talked about also, no one's really sure where to put their money right now, and investing in a long-term renovation that will improve the value of your house isn't the worst decision in the world. So I think there is a likelihood that with that cash on hand, you have your rainy day fund. As long as you have that, there's no reason not to do it, I guess.
Yeah, and I would think it would depend on per market. And it's funny you mentioned rainy day fund, because if you've got a new roof that you need to get, I mean, it sort of feels like one of those things that, like,
yeah,
if it's got a leak in it, you almost got to do it regardless of what the environment looks like. Sort of like AC in Texas or Arizona. It's like a sort of a must-have. There was one other question that came in a little bit more specific to outdoor stuff, but it said the pandemic resulted in massive spending in outdoor projects. Do you think this will continue?
I think for sure, as long as the work from home phase is continuing, because basically obviously the pandemic outdoor space goes together for obvious reasons, but as well as your home basically became everything for everyone. So it was your office, it was your gym, it was your hangout space. And I think investing in outdoor space, for me personally, makes your home feel bigger because you can get out, you can walk around, you can get some fresh air. So that, as long as people are still working from home and the shift to office isn't going back permanently, I'd imagine the investment in outdoor space continues. I'm a big fan, but I guess everyone has their own priorities.
I'm going to add on that a little bit too, because if wood prices are coming down a little bit, for those of you that have never built a fence, I built a fence and I was like shocked at how much the wood cost to build a fence. So with wood prices coming down, now's your time. Build a fence, build a deck, build a pergola, something of that nature. So that makes a lot of sense in that regard. Yeah, it's interesting with people being at their home more. I can definitely see the desire to sort of spend a little bit more on the outdoor stuff. That makes a lot of sense. I recently heard, I'm going to sort of tie a little bit of home improvement projects in with like maybe retail inventory. I was listening to a podcast. Ironically, it was with cryptocurrency, but they were interviewing somebody, and I think a Target executive or whatnot. And the sentiment was that because I guess getting inventory correct for very large retailers is very tricky. Like when you're dealing with somebody the size of, like, let's say a Target or a Walmart, it's very tricky to like sort of get that homeowner demand perfect and like get the right stuff in there. And what one of the executives was saying is that they couldn't time it perfectly. And so they almost, like, because of supply chain issues and then inflation, and they almost had a miscalibration. And the short of it was they had more product coming in. And at the time that the product arrived, they didn't have the demand to sell the product. And so what the exec was saying is, like, with all this inventory, as a retailer, your job is to move inventory. So slashing prices. And so if the demand is not there, what they're going to do is they're going to slash the prices. And so her point was more or less like, hey, outdoor patio furniture, we're going to be slashing the prices on this to move that product out of there, which I thought was really interesting. But it made me think of like, if you had a crystal ball and could time it, there might be some really good opportunities to buy, which leads me to a question for you, which is for yourself specifically. So maybe outside of your economic hat here, when you think of like how to make some of those decisions, is there any sort of thesis you're running through of like, hey, I sort of know that, these retailers are inventory heavy. If I wait a little longer, we might be able to get that outdoor patio or such and such product at a discount. Does that play into your personal buying decisions?
Me personally, yeah, I'm always trying to find the best deal possible. I actually heard about this Target as well as other retailers for this same issue. Is that basically they had ordered so much because they were anticipating as many delays as possible paired with demand, and basically it got pushed too far that the delivery came, and now we're in the middle of summer and they have all their early summer stuff. And that Target and places like J. Crew and et cetera are going to likely have big sales for the summer. How that applies to me, I mean, I'm I'll buy almost anything if it's on sale. I'll buy anything. If I feel like I'm getting a good deal, I'm buying it.
I hear that from my wife all the time, I will say. So I like a deal though. I wait for the holidays, so typically.
Yeah,
There's always a good deal.
I do all my Christmas shopping on that Black Friday weekend, and then I'm done.
Oh yeah. Um, how we're running up on time here, but so much valuable information for our contractors. So I do want to bring it back to our home improvement companies that we work with and just preparing them for the future. And the recessionary times typically are good for home improvements, and I think we've chatted through that historically. I think we're pretty confident that this is going to be a pretty good era for home improvement companies and remodeling specifically. But what should they do to prepare for the next 6 months to a year? What are the things that you would advise them to do? Maybe inventory is a part of that. Maybe financing, lender options is a part of that. Can you, if you were to give us some advice, what's like the top three things that you would advise home improvement companies to do?
I mean, this is going to be cliche, but like based on what we've seen, like the economy is so crazy. Like there's things that change week to week that usually take months. So I would just say this is, I guess, going to be cliche, but be flexible and be ready to react to certain situations as fast as possible, because I think it's really important to take in the information that's happening around you and make your decisions as intelligently as possible, because things are changing really fast. And it could be one day where everything looks really bad, and then the next day, oh, well, consumer spending actually went up 3%. It's like, okay, like you got to stay on top of it, because I was ready to talk about mortgage rates almost looking like they're going to be 6%, and now they're 5.3. So, two, I think what I was saying about home builders maybe having to sell again, contractors maybe having to sell again would be a good thing to consider, because if there's any kind of constriction, standing yourself out there, I think obviously makes sense from a business standpoint. And three, I think navigating inventory is a good one because of those delays, and you don't want to be like, I think the worst thing as a retailer, as you mentioned, having too much inventory and then getting stuck with it can be a killer, because things depreciate, and especially in an inflationary environment, you don't want a depreciating asset, because then you're just getting double whammy.
I want to piggyback real quick just on the first point of being flexible, and only just because this came up in a conversation I had with a contractor recently, and it reminded me of when COVID first went. I hate to use the word viral, but in March of that year, we all understood like the world sort of shut down so quickly. And I remember from a contractor perspective, because virtual sales was not something they were doing; it was all in-home sales, and so many contractors so quickly, because of the distancing and we didn't know how to properly address that, really quickly went to like, how do I keep the sales machine going, knowing that there's this pandemic that's going on there? And very quickly, a lot of contractors had to pivot to virtual sales. Something that if you had asked them 6 months prior, which we all did, Dom, they would be like, you're crazy. I'm never going to do that. And then the pandemic hit, and then all of a sudden people are like, yep, we're standing up virtual sales machines and we're going to do that. And I thought it was a great way to remain flexible in an environment in which, look, we're just doing the best job we can. And it made me, there was a conversation I had last week with a contractor, and Dom, you had brought this up the other day with like rising gas prices, which I know is not necessarily something we focused on, but in the context of our conversation, Nick, it was more of, look, gas prices are heavy. And to drive a sales rep out to, the outer skirts of a territory, and that's their job, they're running 3 to 4 appointments per day, that can very quickly add up, and it can be discouraging, or maybe to some extent where salespeople are like, look, I just don't want to do that, or there's some attrition issue going on with salespeople. And it made me, I told the contractor, I was like, you should consider going back to some virtual sales. You know what I mean? If you have one person in a room, you mitigate the entire gas price right there, right? You can shorten your labor, maybe pay somebody a little bit more. You don't have as many bodies. And it's just the idea that like, we don't know, right? And we have to find ways to either pull sales forward, maybe offer a little bit of a discount and pull some of those sales that would have taken place last year to keep the machine going. But I can't stress it enough. It's probably one of the biggest things I've seen over the last 15 years is how do we remain nimble in a situation that we just don't have as much experience with. So I think that's a great first point that you brought up.
I think that's a great example too. And speaking back to home building, is home building has been historically slow to adapt technology, and I think this kind of pushed a lot of that forward for the better.
Yeah, is there any other technology that you kind of see? I mean, I'm a big technology wonk personally, right? So I mean, yeah, anything that is kind of trending, I'm always trying to pique my interest at. But is there anything like that that you are really interested in that you would comment on that's kind of technology trend wise in the industry that could impact the industry?
Something is that could be really big, but they haven't been able to really get it right yet, is like prefab housing. A lot of companies are entering that space, like Electra and stuff like that. And if they can get it right, I think that would be massive for the industry because it would help alleviate a lot of issues. But I don't think it's there yet on scale, because it ends up being like, hypothetically, it should be a cost saving, time saving venture, but I don't think they're exactly there yet. But hopefully.
Yeah, and that would kind of loosen the impact or lessen the impact of kind of globalization and what's the supply chain impact that globalization has had, right? So in the 90s, we globalized, right? And so and then you had a lot of areas being able to specialize in specific pockets of production, and now that's kind of constraining. I mean, you had like Tesla had to shut down Shanghai factory for like a month, and you saw like the numbers come out and their deliveries went way down. When you start to see those types of things happening, how much of the production is coming back, stateside, and how do you see that proliferating, if any?
I don't think we've seen it happen in big numbers, but I think it's definitely something companies are considering going forward, because I think it's more of, you don't want to put all your eggs in one basket type thing. Because the Tesla example is perfect. If Tesla relies on the Shanghai factory for a huge percentage of its deliveries, and that one thing has a problem, whether it's another pandemic, I hope not, or anything like that, where there's trade embargoes or whatever may happen geopolitically, I think diversification is going to be really important going forward, just so if one tap shuts off, you have another one running.
I got one final question for you, Nick, and I apologize for my obviously I'm not as educated as you in this category, but I can't help but think, based on some of the stuff we've talked about, how important it is to just build a narrative that is positive. When I think of a contractor, I mean, so much of this is like, obviously, like what happens is a byproduct of just millions of different narratives being woven together, and that sort of creates like how people react and behave. But I can't help but think, on an individual contractor level, if you're running a business and you're trying to increase sales or keep morale high, or whatever it may be, I'm just curious of your perspective, like how much of this is just being able to develop a very strong positive narrative that can transcend itself, or move into your sales force, move into the homeowners you're talking to, especially when we talk about, mortgage rates, of like, is this just good storytelling that keeps this moving forward? Or I don't want to make it sound like it's that simple, but I just can't help but think that like that plays a pretty big part in this as well. I'm just curious your thoughts.
Well, for sure. And especially if you're talking about home buying, like there are a lot of people, whether it's prudent financial advice or not, that buy a home because they think it's going to go up in price. And it's just like, that's the narrative, that they see their friends making big equity gains, and that drives a lot of sales. I mean, I don't think that should be a decision maker in your big financial decision, but for a lot of people it is. And it really matters. It really does. If they see their friends making a lot of money, the fear of missing out is real, and that will encourage people to go into making that purchase. And that, I think that applies for a lot of things. Historically speaking, we actually kind of analyzed this in the 4Q18 slowdown, if you guys remember that. It was, rates had pushed up, but there was a really big surge in negative press about the housing market collapsing. And we kind of tracked back compared to Google Trends, like when the first kind of article came out, and then after that, the searches for housing collapse kind of skyrocketed. Of course, that could be timing, because home sales did slow a little bit, but I think it's undeniable that the kind of perception of the housing market, as displayed and as people understood it to be, contributed. Because, I mean, to understand a housing market, it's there's so many facets to it. Like, you have to really study it to really understand it. But if you read one article that says the housing market's collapsing, this is why, that could resonate with you.
Well, I think that's a great place for us to say sayonara. Nick, this has been such a really informative and great conversation. I really appreciate you taking the time to meet with us. Wish we had a little more foresight altogether on where things are going, but I think we're a little bit better informed on where things are going. And yeah, I definitely appreciate you coming on and giving us that insight.
Yeah, thanks so much for having me. I really enjoyed it.
All right. Well, that is it for us. If you like what you heard, please leave us a review on Spotify or Apple Podcasts. Until next time, this has been Built Better.